does Netflix work? Essentially, Netflix is a media company that derives its revenue from its intensely popular streaming service, Netflix. At this time, plans start at $9.99 a month for one screen with unlimited movies and TV shows, and goes up to their premium plan, which is $19.99 per month. That plan offers 4 screens at a time, which essentially is like a family plan. The big news, of course, is that Netflix, for the first time in over a decade, lost subscribers. They lost 200,000 subscribers recently, and these losses stem from their withdrawal from Russia in protest of the war, leading to a loss of around 700,000 subscribers. Remember, subscribers directly correlate to profit for this company, so a loss in subscribers has a notable impact on the company's stock, causing it to tank 35% on the day that their earnings were released. They still have a subscriber base of around 221 million and have continued to produce its high-quality content for its subscribers. The popular content streamed on Netflix includes Friends, Parks and Recreation, Grey's Anatomy, New Girl, Supernatural, and more as listed in the chart on the right from Box.com. Media is an increasingly competitive space with HBO Max, Disney+, and other streaming services growing market share against Netflix. With this in mind, let's talk about the company's market share. Netflix market cap is around $98 billion, making it a large cap stock, and the company was founded in 1997. Now let's analyze the industry. In terms of market share, the company has grown to become around 50% of the market when it comes to streaming services, according to Parrot Analytics. Subscribers and market share can grow through lowering prices, having better content, or advertising. The company has had decent content for a while, but with increasing competition from other streaming services, Netflix has lost subscribers, and they are now beginning to lose market share to the competitors like HBO Max, which is now part of Warner Brothers Discovery, which is Warner Media and Discovery merged. And they also may create a streaming service where they merge HBO Max and Discovery Plus together, and this puts Netflix at risk of increasing competition. With increasing competition, Russia's service removal, and growing competitors, I think Netflix faces tough growth ahead. By age, Netflix has subscribers primarily between the ages of 18 and 44, with older populations lagging behind. This chart is based off of the United States subscriptions I would like to note. As families introduce their kids to the streaming service at a young age and they grow up, I can see that older populations will likely start to consider obtaining Netflix or other streaming subscriptions. This could of course benefit Netflix, so I do see long-term growth potential for the streaming business as a whole. Also, according to a Y-Pulse survey, younger ages are spending more time on YouTube rather than other streaming services like Netflix and Hulu. I think this is in part due to the free cost of YouTube. You simply just have to watch a few ads, and then you can watch your video without paying at least $10 a month for a streaming service. Although ads are of course a pain, people are still able to save money, especially younger ages, and therefore I think this is important as YouTube is essentially a free alternative to a lot of these expensive streaming services. However, any major series is likely going to require a major streaming service like HBO Max with Succession, Netflix with Better Call Saul, and other great hits that have driven new subscriptions in the past and will likely continue to gain traction over the long term as content grows and improves. Netflix price to earnings is still a relatively high 19.41 compared to a Netflix competitor, Paramount Global, which trades at a price to earnings of just 5. Netflix price to earnings is higher than Paramount's, which is concerning at this time as the shares still seem to be expensive after its recent sharp decline. The Dow PE is currently about 20, while Netflix trades at a similar PE, and that can help suggest that there is a seemingly fair valuation of Netflix on the stock market. And for the price to book, we have a similar situation. Netflix price to book is also high relative to other companies in this field. Currently, Netflix has a price to book of 5.47, and compared to Paramount's, which is a price to book of 0.94, Netflix has a high PB. Netflix price to book is also quite low relative to its past PBs, near 20, which is interesting. However, a PB of 5.47 is still very high. I also want to note that this is a high PB relative to the S&P 500 PB of 4.24 currently. However, this is near the price to book of the S&P 500 during the dot-com boom, and this can suggest that Netflix is overvalued with this high of a price to book. If you want to learn more about Paramount Global, previously known as Viacom CBS, check out our long-term analysis on the media business, which I'll link in the description below. In terms of the intrinsic value, the company seems to offer a significant downside of 95% due to a high trading value relative to their negative free cash flow. After projecting the next 10 years of discount cash flows from the past 10 years of cash flows with a perpetual growth rate of 3% and a discount rate of 9%, the company has an intrinsic value of $10.01 per share, relative to a recent trading price of $215.52 per share. Now, there are multiple ways to calculate the intrinsic value, and this is just one way, so please keep that in mind. Also, when valuing media companies, a discounted cash flow projection can be hard to determine their free cash flow, and in Netflix's case, a low free cash flow relative to strong earnings can still lower the discounted cash flow intrinsic value significantly. I don't consider this intrinsic value to be a reliable indicator of how Netflix should trade in the future. I also want to note the company's earnings as their free cash flow, EBIT, and net income appear to be generally increasing over time due to in part of the good content that they are offering and also increasing streaming prices. Netflix does not appear to buy back its own stock according to the shares outstanding record, as they have consistently increased over time. When a company buys back their own stock, the book value increases and the intrinsic value increases as there are less outstanding shares in the market. However, this should only happen when the stock is believed to be undervalued, as the money can otherwise be reinvested back in the company for growth, research, and acquisitions instead. In Netflix's case, they are focused on growth and should keep their cash to try to turn their free cash flow positive. Also, Netflix does not currently pay a dividend. The company is working to turn their FCF positive, or their free cash flow positive, and the company can grow their business with extra cash. In this case, the company shouldn't distribute extra cash to their shareholders, as they can reinvest in their growth and potential acquisitions. So overall, what do we think about Netflix? Netflix still appears to be overvalued at the time of recording, in my opinion. The company has a relatively high price to book within the industry, and a relatively high price to earnings for the time. The intrinsic value is considerably lower than the company's current trading value, which is not ideal. However, other intrinsic values may suggest otherwise. Over the long term, I expect earnings of Netflix to remain steady and positive as they continue to benefit from rising streaming prices but face increasing competition. Netflix offers no dividend and no stock buybacks, which makes sense as we discussed earlier. This stock appears to be a growth stock and less of a value stock in my view, with no dividend income over the long term. And as